Okay, let's unpack this. You've probably seen the headlines about airports of Thailand, or AOT.
Yeah, AOT, it's a huge name.
Exactly, not just any company. It's a giant, deeply connected to Thailand's absolute core sectors: tourism and aviation.
Right at the heart of things.
And the news that grabbed attention recently, its stock price took a significant hit.
A really noticeable drop, reportedly below levels seen even during the toughest days of COVID-19.
Which is quite striking, isn't it? Especially given how central AOT is to Thailand's whole post-pandemic recovery story.
Definitely. A drop like that for such a key player, well, it makes you really want to understand the forces at play.
Absolutely. So based on the sources you shared with us for this deep dive, we've got official financial reports, market analysis, public commentary.
A real mix of perspectives.
We're going after 3 core questions today. Why did this notable stock drop happen right now? Even after the drop, is the stock still considered expensive?
That's a big one.
And what does the broader picture for Thailand's air transport industry tell us about AOT's potential future?
Okay, so we're going to sift through these different viewpoints, try to extract the most important nuggets of knowledge.
Give you the essential insights from the source material to make sense of the situation.
Let's do it.
All right, let's jump right into the performance that potentially triggered this reaction. We have the official financial results from AOT, sourced directly from the Stock Exchange of Thailand.
Yeah.
Looking at their second quarter, which wrapped up on March 31st, 2025, the net profit attributable to the parent company came in at just over 5 billion baht.
Right, 5.05 billion baht to be precise. Now, comparing that to the same quarter the previous year, Q2 2024.
How did it stack up?
Well, back then, the profit was around 5.78 billion baht. So you see a clear year-over-year decrease for that specific quarter.
Okay, so the quarterly profit was down. That seems significant.
It does. But if we zoom out a bit and look at the full 6-month period ending March 31st, 2025.
The first half of their fiscal year.
Exactly. The net profit was about 10.4 billion baht, almost 10.4.
And how does that compare?
That's actually a slight increase compared to roughly 10.35 billion baht in the first 6 months of 2024. So up a tiny bit year over year for the half.
So a mixed bag then. Down for the quarter, slightly up for the half.
Precisely. And the earnings per share, the EPS figures, they reflect this mixed view too. Q2 2025 EPS was 0.35 baht.
Down from
0.40 baht in Q2 2024. So that confirms the quarterly dip.
But the 6-month EPS?
That was 0.73 baht, which is actually up slightly from 0.72 baht for the same half year in 2024.
Interesting. So it seems the quarterly dip might have caught more attention than the small half-year gain.
That seems to be the case. And according to one perspective we found in the sources, specifically from a discussion thread on Pantip.
Okay, the online forum.
Yes. The author there links the stock drop directly to a management announcement. They felt a specific profit contribution figure mentioned, stated as 17.12% in the source, was simply perceived by investors as, well, less than they were hoping for.
So missed expectations, basically, even with the slight half-year rise.
Kind of. And what's interesting about that viewpoint is the author's own surprise.
Why were they surprised?
Well, especially considering all the recent tourism-boosting measures from the government. You know, the free visas, extended stays for Europeans.
Things you'd think would directly pump up the numbers.
Exactly. You'd think those would translate directly into better results, so the perceived shortfall became a real focus point.
That same source, the Pantip discussion, it also dives into a specific point of contention, doesn't it? Regarding the duty-free concessionaire, King Power.
Ah, yes, that came up.
Yeah.
The management's official line, as quoted in that source, was basically, no problem here. Meaning, they said it wasn't affecting how they recognize revenue. Revenue is booked monthly, and importantly, there's a bank guarantee in place to cover the contracted minimums if needed.
Okay, sounds straightforward, but
this is where different interpretations really come into play. The Pantip author pushes back quite strongly on that. They argue that if the operator, King Power in this case, is paying interest on debt related to the concession, instead of paying the full minimum guarantee amount directly, then it does affect the actual cash flow and the expected profit outcome for AOT. It might be legally covered by a guarantee, but the immediate financial reality is different, is their point.
So less cash coming in the door right now, even if it's guaranteed later.
Potentially.
Yeah.
And they go further, suggesting this isn't just an issue with the operator's ability to pay, but might be linked back to AOT's own past management decisions.
Like what?
Like decisions made previously to cut concession payments during tougher times. They frame it as maybe partially AOT's own doing, not solely the operator's issue.
So it really highlights how the same set of facts can be viewed through very different lenses when it comes to the real financial impact, at least according to these sources.
Absolutely. Different interpretations of the same situation.
Okay, so we've got the quarterly dip, the slight half-year gain, missed expectations perhaps, and some specific friction around concessions. This leads us right into that second core question, the one from the Hot Topic source. Even after this price drop, is AOT still expensive?
Right, the valuation question. To tackle that, the sources point us towards valuation metrics, and the most common one that comes up is the price-to-earnings ratio, or PE ratio.
PE ratio. Okay, remind us quickly what that is.
Sure. The GuruFocus source explains it simply. It compares a company's current market price per share to its earnings per share, or EPS.
And they had a good analogy for it, didn't they?
They did. You can think of it as roughly how many years it would take for the company to earn back the price you paid for one share of stock based on its current earnings power.
So generally, a lower number looks more attractive, suggests you're paying less for each dollar of earnings.
All else being equal, yes. So as of June 5, 2025, GuruFocus puts AOT's current PE ratio at 23.71.
Okay, 23.71. What's that based on?
That's based on the share price at the time, which was 31.75, and the company's earnings over the past 12 months, ending March 2025. That's the TTM, or trailing 12 months EPS.
And that EPS figure was?
It was 1.34, using the diluted EPS figure.
Right. Now, 23.71, is that high? Low? How do we know?
Well, context is key. GuruFocus provides historical context for AOT's PE over the last 13 years.
And what does that show?
The lowest it ever got in that period was 21.53.
Yeah.
The median, kind of the middle value, was 39.33. And the highest was a staggering 269.44.
Wow, okay, so that 23.71.
Exactly. What stands out immediately is that the current PE of 23.71 is quite close to that historical low of 21.53.
Much lower than the median, too.
Way below the median of the 39.33. GuruFocus even flags it as a good sign in their analysis, noting that the PE is near its 5-year low.
So on the surface, compared to its own history, it looks relatively inexpensive, maybe even good value.
On the surface, yes, relative to its past valuations. But, and this is a really important, but GuruFocus adds a significant cautionary note, which the PE ratio can be incredibly misleading, especially for businesses that are cyclical.
Like air travel and airports, which definitely have their ups and downs.
Precisely. Why misleading? Because think about it. At the peak of an economic cycle, when travel is booming, earnings are high. High earnings make the E in PE large, which makes the PE ratio look artificially low.
Right, so it looks cheap just when things are maybe about to turn down.
Exactly. That could actually be the worst time to buy, even though the PE looks good.
And the opposite is true, too.
Yes. At the bottom of a cycle, like during the depths of COVID, earnings are depressed or even negative. That makes the PE ratio sky high or mathematically meaningless.
But that might actually be the best time to invest, looking ahead to the recovery.
Potentially, yes. So the takeaway is, you have to be really careful interpreting that low historical PE. It doesn't automatically mean it's a bargain now. Context is everything.
Understood. Did GuruFocus provide any other PE variations?
They did briefly mention the PE ratio if you strip out any non-recurring items, or NRI, things that aren't part of the normal ongoing business.
And what was that?
That stood at 23.41, so very close to the main PE. The TTM EPS without NRI was 1.36. It just confirms the valuation looks similar, even if you adjust for potential one-offs.
Any growth context there?
Yeah, they noted that this NRI-adjusted EPS had grown by about 12.5% per year over the past 12 months on average. So recent earnings growth has been decent.
Okay. So PE gives us one snapshot. Looks relatively low historically, but we need to treat it with caution because of the cyclical nature. It's not the whole story.
Definitely not. And to truly understand where AOT might be headed, we really need to step back and look at the bigger picture, the trends, and the outlook for the entire air transport industry in Thailand.
Right, the environment AOT operates in.
Exactly. And the Krungsri research source provides a really detailed view here. It's quite comprehensive.
And what's the main takeaway from Krungsri? What's their overarching message?
It's quite optimistic, actually. They project the air transport business as a whole will recover back to its pre-COVID-19 levels sometime within 2025.
Okay, so a full recovery is expected fairly soon. What's driving that optimism?
They list several key engines. First, they anticipate gradual, stable growth in the global economy and international trade.
Do they give numbers?
Yeah, they mention IMF forecasts for the next few years, 2024 to 2026, showing global GDP growing around 2.9 to 3.2% annually, and global trade expanding around 3.5 to 3.7%. Steady, if not spectacular, global growth.
Okay, what else?
Second, Thailand's own domestic economy is expected to see solid growth. Krungsri themselves forecast it at 3.0 to 4.0% annually over the next 3 years.
And tourism is a big part of that Thai growth,
A
right?
huge part, and that's the third driver, tourism itself. The forecast for foreign tourist arrivals is very strong,
How strong?
potentially hitting 43 million visitors by 2026, which would be well above pre-pandemic levels.
Is that just wishful thinking or is it backed by anything?
It seems well supported. They point to active government policies specifically targeting high-spending and high-potential visitor groups.
Like who?
Things like long-stay visitors, medical tourists, MICE groups, meetings, incentives, conferences and exhibitions, sports groups, LGBTQ plus travelers, and focusing on key big spending markets like Chinese and Indian tourists.
Plus those visa initiatives we mentioned earlier.
Exactly. Initiatives like the ongoing free visa policies are designed specifically to make travel to Thailand easier and more attractive.
Makes sense. What about infrastructure? That's crucial for airports.
Absolutely. And that's another key factor Krungsri highlights. Significant infrastructure momentum. The government has clear plans to upgrade airports and related transport links.
We've already seen some of that, haven't we?
Yes, the source mentions the recent opening of the Suvarnabhumi Satellite 1 terminal, which boosted capacity significantly at the main gateway.
And there's more planned.
Oh yeah. The source lists planned improvements and expansions at other key airports across the country, plus efforts to increase airspace capacity and highway projects to improve connectivity to the airports. It's a broad push.
Okay, global economy, Thai economy, tourism push, infrastructure build-out, anything else?
One more piece. The airlines themselves. They're actively playing their part in the recovery too.
How?
They're planning fleet expansions, they're increasing flight frequencies on existing routes, and they're adding new routes to connect Thailand with more places.
More planes, more flights, more destinations.
Pretty much. And interestingly, the source even notes that 9 new airlines are expected to start operating in Thailand from 2024 onwards.
9 new airlines. Wow, that's a lot of new competition.
It is. Although Krungsri adds an interesting side note here. They suggest the number of available aircraft might not grow as fast as passenger demand initially.
Meaning?
Meaning there could be a potential seat shortage, particularly this year, 2024, which, counterintuitively, could actually give the existing airlines a bit more pricing power in the short term.
Interesting dynamic. So, okay, that's the overall industry wind seemingly blowing in AOT's favor. What does Krungsri say specifically about the airport's business segment, which is AOT's core?
Right, focusing on AOT's playground. For airports, the outlook is understandably for strong revenue recovery as those passenger numbers and flight numbers climb back up.
And they have a strong market position, don't they?
Extremely strong. Krungsri highlights AOT's position as essentially a near monopoly in operating Thailand's major international airports.
Which gives them certain advantages.
Definitely. It gives them relatively stable income streams from what are called aeronautical fees. That's things like landing fees, parking fees, passenger service charges, aircraft charges, things airlines have to pay to use the airport.
And the non-aeronautical side.
That too. Revenue from concessions, think shops, restaurants, duty-free, and rental income from spaces within the airport. That's also expected to recover strongly as traffic returns.
And they benefit from those government infrastructure plans.
Directly. They're seen as being really well placed to benefit from those investments, suggesting potential for continuous and stable revenue growth going forward.
Does the report give any specific forecast numbers for traffic through AOT's airports?
Yes, it does. For the period 2024 through 2026, they project total passengers, that's covering both inbound and outbound international and domestic, to grow by around 13 to 15% per year.
And will that get them back to pre-COVID levels?
Yes. They expect to surpass the 2019 peak passenger number, which was 165 million, by the year 2025 reaching about 168 million then, and climbing further to 179 million in 2026.
What about the number of flights?
Total flights are projected to increase by a healthy 10 to 20% per year. Domestic flights are expected to recover to their pre-COVID peak levels, possibly this year, 2024.
And international?
International flights are expected to hit their pre-COVID peak by 2025. So a staggered recovery, but recovery nonetheless.
Okay, passengers and flights look strong. What about cargo? Is that part of the picture?
Yes. Cargo volume is also expected to grow, though maybe a bit more modestly, by 3 to 5% annually.
What's driving the cargo growth?
A few things. Better infrastructure connections linking air, sea, and land transport. The massive ongoing growth in e-commerce is a big factor. The source projects the Thai e-commerce market alone growing 16% per year in 2024-2025.
Wow.
And also government initiatives specifically aimed at positioning Thailand as a regional hub for agricultural cargo. They even mentioned a specific facility being developed at Suvarnabhumi aimed at increasing perishable cargo capacity significantly by 2027.
Okay. So the demand-side passengers, flights, cargo looks pretty robust, with clear drivers pushing it forward.
It does look that way based on the Krungsri analysis.
Yeah.
However, and it's a significant however.
Here come the challenges.
Exactly. Krungsri is also very clear about identifying several key challenges or risks that could potentially temper this positive outlook, or at least put pressure on profitability.
All right, what are the main headwinds we need to be aware of?
Well, first, there's always the risk of a slower than expected global economic recovery. If the world economy stumbles, people have less discretionary income, and travel spending is often one of the first things to get cut.
Makes sense. What else?
Competition. Increasing competition from other tourist destinations in the region. The source mentions countries like Hong Kong and Taiwan actively offering their own incentives and packages to lure tourists away. Thailand isn't operating in a vacuum.
And geopolitical risks. Still a factor.
Very much so. Global instability from geopolitical conflicts remains a major wildcard. That can cause sudden volatility and, critically, push up jet fuel prices.
And fuel is a huge cost for airlines.
It's typically their biggest single operating cost. So higher fuel prices squeeze airline profits, which can indirectly impact airports. Plus, conflicts can directly dampen travel demand from specific regions involved or perceived as risky.
What about competition among the airlines themselves? We mentioned those 9 new entrants.
Right. That intense competition, especially with new players coming in, could limit the airline's ability to raise fares, even if demand is strong. That pressure on airlines can eventually translate into pressure on airport fees and concession revenues.
Any operational constraints mentioned?
Yes, potential limitations in service capacity are flagged. Things like persistent labor shortages in aviation pilots, ground crew, air traffic control, or aircraft deliveries not keeping pace with the planned expansion. Bottlenecks could emerge.
Okay, those seem like fairly standard industry risks. Anything else particularly noteworthy?
Yes, one area Krungsri really emphasizes is the rising cost of compliance with international environmental standards. This seems like a major structural challenge.
Right. You mean things like the push towards sustainable aviation fuels, or SF, and those global carbon reduction schemes?
Exactly that. Schemes like CORSIA, that's the Carbon Offsetting and Reduction Scheme for International Aviation, are becoming mandatory for international flights. And there are increasing mandates to start blending in sustainable aviation fuel, SF.
And the problem is the cost.
The huge cost difference. SF is currently projected to be anywhere from 3 to 5 times more expensive than traditional jet fuel. That's a massive cost increase to absorb.
Are there specific targets mentioned for Thailand?
The source mentions Thailand aiming for 1% SAF usage by 2027 as a starting point. For comparison, the EU already requires 2% SAF blend from 2024, and that percentage is set to ramp up significantly over time.
So these costs are only going to grow.
It looks that way. And then you have the longer-term, even more ambitious goals like the global airline industry's commitment to fly net zero carbon by 2050.
Which
will require absolutely massive investment in developing and deploying new, more fuel-efficient aircraft, potentially alternative propulsion technologies like hydrogen or electric when feasible, advanced air traffic management, automation. It's a huge technological and financial undertaking for the entire aviation ecosystem.
Including airports, which need to support these new fuels and technologies.
Absolutely. Airports will need new infrastructure for SAF handling, potentially for hydrogen refueling or electric charging stations down the line. It all adds up to significant increasing costs across the board.
Okay, so to summarize the industry outlook, strong underlying recovery trends, good government support, positive demand forecasts, but sailing into some pretty strong headwinds from rising costs, especially environmental compliance, plus competition and global risks. A nuanced picture.
Very much so. It is. And, it's worth just circling back briefly to those public discussions mentioned in the sources.
Right, the ones from the pan-tip thread alongside the official financials and the market forecasts.
Yeah. The author of that source felt these other points about AOT's internal management and operations were relevant context, things perhaps not fully captured or addressed in the official announcements around the financial results.
And just to be clear, we're reporting these as points raised in that specific source, not endorsing them, right?
Exactly. We need to present them impartially as they appear there. The source raised concerns about potentially high bidding prices being accepted for various AOT projects.
Were examples given?
Yes, the source mentioned things like wastewater system maintenance contracts and also made allegations about technical specifications being potentially reduced for the construction of the third runway at Suvarnabhumi.
Anything else?
There were also allegations raised related to procurement practices more generally. The specific example cited in that source was the sticker case controversy at Phuket Airport.
Okay.
And finally, that source also discussed comparisons that were being made publicly between apparently high employee bonuses paid out by AOT and the actual bottom line profit results being reported.
So these are points of public conversation highlighted in that source.
Correct. Presented by the author there as additional factors that they felt might have contributed to why investors perceive the profit outcome as a shortfall, especially when viewed against the backdrop of those positive overall tourism trends.
Just another layer of complexity from the sources. Okay, wow. We've definitely covered a lot of ground here, digging through these different sources. Let's try and tie this deep dive together.
Sounds good.
We started with that notable stock price drop for AOT. It seems clearly linked, at least in part, to those Q2 profit figures coming in below what some investors were expecting.
Yeah, that quarterly miss seemed to be a key trigger. And we saw there were different takes on why exactly that happened, whether it was just expectations being too high or if specific issues like those discussions around the duty-free concession arrangements played a bigger role.
Then we looked at the valuation, focusing on the PE ratio. On the one hand, it appears relatively low compared to AOT's own historical range over the last 13 years, even getting close to a historical low point.
Which superficially looks attractive.
Okay.
But we have to remember that crucial caveat. For a cyclical business like airports and air travel, a low PE can be deceptive. It might appear when earnings are temporarily high, masking underlying risks, though you could argue earnings aren't quite at a cycle peak yet for AOT. It needs careful interpretation.
Definitely. And then we zoomed out to the big picture, the outlook for the whole Thai air transport industry.
And the sources there, particularly Kringsri, paint a generally positive long-term forecast. It's driven by that strong expected tourism recovery, supportive government policies, and significant planned investment in airport and related infrastructure.
All factors that should, in theory, directly benefit AOT's core business, given its dominant position as the main airport operator.
Absolutely. They're well positioned to capture that recovery. Yet, as we discussed, that recovery journey isn't without its bumps. It's facing some significant headwinds.
Right. The industry, and therefore AOT, has to navigate these rising operational costs, intense competition from other destinations and among airlines,
Potential operational constraints like labor or aircraft shortages, lingering global economic and geopolitical risks.
and critically, those escalating compliance costs, particularly related to environmental mandates like SAF and the net zero transition, those seem like major long-term cost pressures.
They really do. And layered on top of all that, we have those public discussions captured in the sources, raising questions around management decisions, procurement practices, and spending priorities that some feel are relevant context for investors.
It certainly paints a complex puzzle, doesn't it? There's no single easy answer here.
Not at all. You've got the immediate financial data showing a mixed picture. You've got a valuation snapshot that looks maybe cheap historically, that needs caution. You've got strong forward-looking industry trends.
And you've got substantial challenges and rising costs the industry faces, all mixed in with these other points of public discussion about the company itself.
Exactly. Different pieces of the picture pointing in slightly different directions or adding important layers of nuance and risk.
So here's a final thought for you, the listener, to maybe mull over as you reflect on everything we've unpacked from these sources today. How do you weigh it all up?
Yeah, how do you reconcile that recent dip in reported performance and those specific operational or management questions being raised in some discussions?
With the overall, generally very positive trajectory that's projected for Thailand's air transport industry recovery and AOT's powerful position within that future.
What does this deep dive really highlight for you about the complexities involved in trying to understand and value a major infrastructure-heavy company like AOT, especially during this unique period of post-pandemic recovery, coupled with significant costly industry transition towards sustainability?
Something to think about.